The price of a single-family home in Canada is quite reasonable, as long as you're not looking in Toronto or Vancouver. The latest housing affordability report from RBC finds house prices are stable or improving in most of the 14 markets it covers. But when it comes to Toronto or Vancouver, the market is dangerously unaffordable. For someone with an average income and a 25-year mortgage, a home in Vancouver would take 109% of your pre-tax income. Contrast that with St. John's or Regina, which come in under 30%. Craig Wright is a senior vice president and chief economist at RBC and is one of the authors of the report. So what stood out most to you in doing this report, Craig?
I think what we saw in the data was similar to what we're seeing across the housing market generally. People speak of a Canadian housing market, but there's really no one single housing market. There's a number of regional markets. And what we're seeing is in most markets, housing is still quite affordable and leveling off and below its long-run average. But when we look at a couple of exceptions, it's Toronto and it's Vancouver. And importantly, it's detached homes relative to condos. So affordability in those two areas is very challenging.
How do you measure affordability?
Yeah, so we look at the amount of pre-tax income necessary for principal, interest, taxes, and utilities. So we're comparing average income to the average price of an existing home, and that's the measure that we come up with. We've been doing it since the 80s.
So it's basically how much money you're making, how much would you have to pay? We were talking about how many months it would cost.
Yeah, it's challenging in some areas, and so we tend to look at how the cities compare across Canada, but then also how they compare to the long-run averages. Some places tend to have higher prices over a long period of time, and when you look at that, the majority of markets that we look at, of the 14 we look at, the majority of them are at or below their long-run average. It's really just the two exceptions that continually stand out and likely remain standouts for some time to come.
Right. I mean, we are constantly hearing about Toronto and Vancouver and how crazy, that house in Vancouver last week went for $750,000 over asking. But I'm interested in some of these other markets. Like you're saying, not only are they stable, but they're improving. Why is the affordability improving in some of those markets?
So it's a combination of factors. One, interest rates have been fairly stable for some period of time, so we're not seeing any pressure from interest rates. So a lot of what we're getting is either from the price side or from the income side, right? The price impacts the numerator, and then it's all relative to income. So as long as incomes are strong and growing, then that offsets some of the increase we've seen in prices. But in most market, prices are fairly modest. You're not seeing those double-digit gains like you are seeing in Toronto and Vancouver. So with modest gains in prices, as long as the income keeps going, you see that affordability continue to remain quite affordable relative to your own history.
So it's not that any the property values are trending down in some of these places?
Well, there are a few markets where I've seen price declines, modest price declines, and that's probably a trend we're going to continue to see. And if you look at a few of the markets that we look at, the energy-intensive provinces or cities, they're obviously under more pressure, and we'll probably continue to see prices soften in the markets like Calgary, Edmonton, Saskatoon, St. John's, Newfoundland, and the like. So there's a few weak spots, but the majority of markets, I think, are quite balanced and will continue to push modest price increases.
Now, you use the term in Toronto and Vancouver that the overvalue is dangerously high. What's the danger?
Well, whenever you get to these high levels of valuation of anything really, you're vulnerable to some sort of shock. And the shock most often one worries about in the housing market is interest rates to some degree, but arguably more important shock is the employment. And as long as consumers have jobs, they'll continue to service their mortgage and it won't be a strain. So the key indicator to look at, I would argue, is the employment. As long as we continue to see these job gains, and where we're seeing the job gains are in the markets like British Columbia, like Ontario, and that's a trend we expect to continue as the economy adjusts to this low oil price environment.
People are always talking about these, huge prices that some people are paying, or even if it's not a huge price, just that people are perhaps taking on more debt because interest rates are low. And then, of course, they always use the term when interest rates inevitably climb, because, of course, they can't stay this low forever. But is there any scenario where you see interest rates rising rapidly?
No, not in the current environment. I mean, when you look around the globe in terms of global economic environment, the biggest worry is deflation, not inflation, and central banks in some cases are moving into negative territory. In other places like Canada, very low interest rates for a long period of time. So it's pretty tough to see a significant rise in rates. But if rates do rise, it's because the economy is strong. So you usually get that in an environment of stronger gains in employment. And we also have fixed rate mortgages, and so that cushions the adjustment, and not everybody with a house has a mortgage, and there are a number of people that don't even have a house. So there are a number of mitigating factors, if you will, but rates don't look like they're going to rise significantly anytime soon. We do think they'll move modestly higher through the year, which should cool the housing market, but not a collapse.
Right. And is there anything you think the government should be doing to cool things off?
Well, we've seen a number of rounds of mortgage tightening, or as they call it, macroprudential regulation. But I think they're just sort of setting speed bumps. And when you look going forward, I think the next big factor will be the interest rate. That tends to be the biggest lever. And as I suggested, rates don't look like they're moving significantly higher. So it's going to continue to run for a little bit longer, I suspect.
All right. Well, thanks so much for being here.
Pleasure. Thank you.